Hi everyone, Adam here, and welcome to this week's episode of Midweek Market Focus. So first of all, what are we going to do on the agenda for this evening? It is Wednesday, the 18th of February. We are going to start by having a look at the market overview. What is going on in currencies, commodities, and the indices? What's going on in the markets? Then we're going to focus on which are the best markets to engage in right now, which markets should we be avoiding, but where are the opportunities, where are the safer opportunities, so to speak. And then the topic for this evening is a first principle. This is something that new traders are not necessarily taught, and if you understand this, it will be life-changing for your trading. You need to apply this, and this is what we call a first principle. So what is it? It is understanding multiple time frame correlation. All right, and this is one of the kind of ways in which the markets work with regards to market mechanics. Now, that being said, let's go across, let's kick off. Let's have a look at what's going on in the markets. Okay, so we start off with euro dollar here. We're starting off on the monthly. Why are we doing that? Because the monthly gives us a sense of perspective, and this is where we are so far. We are 2/3 effectively through February, and we have moved very, very little from top to bottom. Let's just see what the range is from top to bottom. It's just tiny. Let's have a look here. The high 1928, the low 1765. That's a joke. Okay, it's not even 200 pips over a month. This is ridiculous. We're still struggling to get away from this. So I need you guys to understand stuff, that if you are one of those traders who engages in euro dollar daily, you just wouldn't have seen a lot happening. This is the last 3 weeks. Look at this. It's kind of sideways. There's just not a lot happening. And if you go down to the daily, it's just a mishmash. So day traders have been struggling, and also because if it's moving a very small amount, how do you make money if the market's not moving? That being said, we're still testing this level. We're still outside the range at this point, and at some point we could see it ultimately reject this level. You need to understand that predominantly the dollar is kind of the biggest fly in the ointment, would be the best way to put it. But we can see that some of the other majors are trying to break free, are trying desperately to uncouple from the dollar. We could see them attempting to do that. If we could say Aussie dollar, US dollar, we recently produced, this was pretty nice yesterday, nice bullish candle. Typically this would be a nice buy opportunity, one over there. At that point the momentum is nice and bullish. It's just been going sideways for a few days, but the prevailing trend is still to the upside. If we have a look at dollar Swissy here, the prevailing trend again is also to the downside here, broken out of a range. Usually when it breaks out of a range like this and drifts, it either goes back into the range and it's a failed breakout, or it moves. It's just not doing anything here. So again, there's just this hesitation and just waiting, I guess, for something else to happen. So let's have a quick look at cable. So again, on the monthly, these are your major levels. If you zoom out, you can see where the major levels of resistance are. You can see where we're struggling to get past here, and you can see where the next levels are beyond that. But it doesn't really matter. We're kind of just stuck between these two levels for now. So that's it. That's all you need to know, is that the difference between these is, 3725 and 3342. It's a 200-300 pip range, and it's very tight, not doing a huge amount. So in case you're just not really sure why things are the way they are, that just explains it as well. We're sitting literally at the middle of the range, and today it's touching the center axis of that. Okay, let's move on to dollar yen. Okay, so dollar yen for me is potentially of some interest here. Remember that the problem is that dollar yen is definitely impacted by a weaker or stronger dollar. This is what I want to have a look for, and this is why this is on my watch list this week, carrying over from last week. I'm looking to see if we find some resistance here between today and tomorrow over the next 24, maybe 48 hours. If we go across to the other yen crosses, all right, so the yen pairs, this is what I like. Euro yen breaking through that. Is it going to find some resistance? So what am I looking for here? I'm looking for a nice bearish candle, nice rejection, or maybe even multiple, something maybe similar to this but upside down, and then looking for it to reject that and head down. So that would be euro yen. Pound yen has got a similar situation here. I'm looking for this to potentially find some resistance where it is in this area and possibly continue down. There's nothing happening yet. There's not enough exhaustion here. This doesn't look great. I need to see longer wicks on top, more exhaustion there in this area, and then I would expect it to continue down. CAD yen, let's have a look at that. Again, CAD yen here is stuck between support here and the upper end, and I'm not seeing anything yet, so there's nothing on CAD yen. But the yen crosses in principle, that is really what I'm looking for. Euro yen here looking like a really good area here for this to find, to reject this. Now, what could happen is that this could take the whole week to struggle and fail and then only start moving next week. So if that is the case, then just so be it. It's frustrating, but that's it. Now we spoke about, and I spoke about Aussie dollar strength. So let's have a look at Euro Aussie here, producing a bearish candle, starting to break down here. This was on my watch list. Also Aussie CAD as well, pulling back, bullish candle, starting to push higher. That's being driven by the Australian dollar. Okay, so this is one of the more attractive charts, liking the look of this. The yen pairs looking very attractive to me as well. And then let's move across. Let's have a look at the global indices. So global indices here as well. Just zooming out here, you can see that we're continuing to push higher. Of the three big US ones, that being the Dow, the S&P, and the NASDAQ in terms of age. Obviously, the Dow is the oldest, then the S&P, and then, of course, the NASDAQ is the youngest. We are predominantly seeing a move to the upside. The Dow itself is behaving slightly better. That's it. It's still a mess, but it's still behaving slightly better over here, and I can see it looking to push higher. So the Dow actually looking fine. The S&P not looking as good. It's still going sideways. It's still within its range. It's still producing bullish signals here, but it's still range bound. And remember, the reason we're watching the low over here at 66,731, I beg your pardon, is because we're looking to see a break and a close below that. We're still in a bull market. We're just going sideways. And as such, it's not impossible that we consolidate for a while and then break higher. A lot of people are very pessimistic at the moment, but the reality is, the truth is, the undeniable reality is we're still in a bull market. The market isn't doing very much, but that doesn't mean that it's about to collapse. Of course, that's always a possibility. But right now, this is looking much more bullish than anything else. NASDAQ as well, sideways, creeping down. The really big level that we want to pay attention to here is going to be 24,000. Right now, the market is trying to stay above 24,000, almost 25,000. It's trying to stay above that. And again, it's going sideways. All right, so we've got a little bit of divergence here, but what you have to understand is that right now, what the market is doing is going through a consolidation. It's really just recharging its batteries at this point in time. So let's leave the US, let's go away, let's have a look at the UK, the FTSE here, which is on fire even today as we go, looking amazing, producing a very nice bullish signal over here. This was a very, very nice one and a relatively obvious one actually. This one over here, and it's still going. Now it's becoming a little bit overextended. All right, so we don't have any buy or entry opportunities here. I'm looking for pullbacks. If we go to the weekly, I actually did a standalone, just ignore that. I did a standalone review of this, was it yesterday, I think? So you could have a look at that. UK stocks as well are on fire. They're not overvalued. They look really good, nice and healthy. So unless there's some unexpected things such as a COVID or some kind of a black swan, let's call it a black swan, something unexpected. These markets are looking fantastic. I'm looking for pullbacks here. So let's see what that 4 hour looks like. Again, it's going to complain. Don't worry about that. That's just a signal indicator. Any kind of a pullback here for me would be a buying opportunity. Daily still looks really good. It's only 2 days away from the moving average. So it's got a day or two more left before it starts a pullback. So probably next week will be some form of a pullback. So I'm going to mark it here. I'm waiting for a pullback for this to happen somewhere in next week. So let's see where we are by this time next week, but looking for a buying opportunity there. Going across to the DAX, looking fantastic as well. This one has been late to the party, but is looking very nice and bullish. Very nice breakout chart, beautiful uptrend, solid. And it's actually just broken through here. So even day traders coming here as well, excuse the signal generator, it'll be pulling back and testing this, just looking very good. So day traders, I think from tomorrow, before the end of the week, there should be some nice buying opportunities there. This looks really good. If you go to the weekly, yeah. You go to the weekly, just a fantastic breakout, pullback, bullish engulfing bar, and here we go. We're on our way. So all of this looking very nice and bullish. Love it. Eurostoxx as well, also here starting to break out today. So the markets today, very nice and bullish. Just a series of high lows, just a no-brainer. Looking very, very cool. Let's go to the Nikkei. Nikkei, there we go. Literally just taken off as we kind of pointed out here. Very nice little bullish bar there. So again, if you looked at last week's episode, if you looked at my Sunday night episodes, and if you watched last night's one, none of this is a surprise to you. We know we're in a bull market. We know the markets are looking nice and bullish. They look fantastic. Okay, so I mean, all of these so far are looking very appealing. HK, I think, is going to break out soon. It's a bit of a lagger. It is the weakest one in its defense. It is the weakest one, but even so, it is still in a bull market, and it is preparing itself for a nice breakout soon. So that's good. Right, let's have a look at gold. What's happening with gold? So gold's a bit of a mess at the moment, but not completely worthless, not a waste of time. Even as we speak here, it's trying to produce a bullish candle. I'm just going to extend this thing here. Just extend that so we've got a level there. Oh, come on, man. As I'm drawing it, of course, it decides to just... There we go. So that's a nice little level to watch. We still look pretty good. I don't think we're overextended. What I think we're likely to see, this is the level to watch. So I do want to see how we break above that 5,100 level. But actually, as long as we stay under this, we're just recharging our batteries. So the best case scenario here is it takes a few more days, even a whole other week, just goes sideways for a bit and then breaks out, and then it's just going to charge. So I like the look of that. Silver also looking good. It's just consolidating at the moment. Let's go to the weekly. Have a look at it from it here. It looks good. I mean, the way all it's doing right now is recharging its battery. It's not collapsing, it's not taken off, it's just recharging. So I like the look of this. All of this is, to my mind, is what I would call resting bullish, I guess, recharging its battery. I like the look of that. Crude oil. So crude oil from a monthly perspective, again, this is a major level at $65. It doesn't know which way it wants to go just yet. It looks like it wants to push a little bit higher, but it's not actively driven. I think the key thing is, can it break through this level? And it's meaningless until it actually does break and close above that level. Right now I've got that level at $66. Doesn't matter, it's about $65, $66. I've got it there, but it really has to decide. It's still battling this. Ultimately it could fail. It's possible that it could fail here and then end up going down. So until we see a break and a close above that, then I would expect it to go higher. Otherwise, if we keep getting rejections, I would expect it to go back down to that $55 level. So there we go, ladies and gentlemen. There's actually some stuff going on in the markets. The majors themselves, Aussie pair is possibly the most attractive out of the whole bunch. Maybe we'll get some yen crosses that'll start to sell off later in the week. Crude oil, gold, sorry, I beg your pardon, gold and silver not really doing much. It looks like it's the indices that are offering the best opportunities this week. So, and they're definitely, looking pretty decent, especially the non-US ones, and within the US ones, the Dow is looking fantastic. All right, that leads me to our central topic for this evening. Okay, understanding multiple time frame correlation. This is what we call the first principle. What is the first principle? The first principle is a concept, like a rule that the markets tend to obey. Kind of, they have their own set of rules, just like everything else in life does. And this is one of the biggest ones. And so we'll start with this idea here that we'll talk about the higher time frame and the lower time frame. So the higher time frame, which is in blue here, is interesting to me. It's the daily, the weekly, the monthly, right? So this might be the first time you're hearing this. It's possible. Let me just shrink something with the slides and give me a second. Just wanted to update the stuff at the bottom here. So, oh, there we go. I have to fix that now. Stand by. There we go. Let's try that again. Okay. So the blue being your higher time frame. All right. And you've got, that's your 4 hourly, your daily, your weekly, your monthly. Now you've got to understand that the bigger money is on the higher time frames. The pension funds, mutual funds, they are sitting in on the weekly and the monthly. And then you've got your hedge funds, which are sitting in on the weekly, the daily and the weekly. Then you've got your swing traders sitting in on the daily and the weekly. You've got day traders coming in on the lower time frames, maybe running over the daily. And of course, then on top of that, you just got this layer of day-to-day activity. So bigger money tends to drive the longer term time frames, and then the kind of rollover starts to get smaller and smaller as you come down the time frames. So the higher time frames, this might be the very first time that you're hearing this, but it's the higher time frames that drive the lower time frames. The lower time frames follow the higher time frames. You've got to think about the bigger waves, and then you've got to think about the lower time frames being the smaller waves on top of that. And this is something that not a lot of, this isn't taught very well, but you need to understand. Absolutely, we've got these bigger waves and the smaller waves operating on top of that. And so what does that actually mean? It means we do need to know where the 4 hourly is going, where's the daily, where's it going? And we have these cycles, right? So we have this breathing out, breathing in, breathing out, breathing in, breathing out on the higher time frames. And every time frame has its own cycles. The cycles are there, ladies and gentlemen, because that's what happens as part of the normal activity of buyers and sellers getting in and out of the market. When you get a really good trend, what happens is that there are just simply more buyers and sellers, or more sellers than buyers. There are lots of activities that happen in the markets because they have to. People are traveling, tourists are exchanging money on the day, they don't plan it ahead. People are buying stuff off Amazon or paying suppliers and sending money abroad. None of that stuff is planned long in advance. It's just part of the day-to-day activity, market activity. But then you also get people that are accumulating positions over time or offloading positions. And so you do get these longer term trends. And it does often happen where on top of that you get speculators who have identified where the flow of price is going, and they decide they want to get on top of that, and so it accumulates momentum. And so when we see this, what we're seeing is momentum on a higher time frame, and then of course we can get lower time frame momentum on top of that. And this is what we want to do. Okay, so this means, and this is the important part, is that while the higher time frame has this extension, retracement, extension, retracement, or phase one, phase two, all these cycles of breathing out and breathing in again, and then breathing out and breathing in again, the lower time frame, and this is the important part, will have its own little subset of a trend. It will have extension, retracement. But what happens is, in this very interesting part here where the higher time frame is simply breathing in, the lower time frame will actually have a temporary change of trend. It's a temporary change of trend. All right, so the bigger time frame is heading upwards here, and the lower time frame goes from an uptrend to a temporary downtrend, back into an uptrend, and back into a temporary downtrend. This is important because if we look at the end here, we know that at some point, if it's going to repeat what it's done here, the higher time frame is going to pull back. That means that the lower time frame is going to change trend. Okay, so it sometimes seems a little bit like magic when a seasoned trader says, look, I expect the trend to change now, and a newer trader says, how can you possibly predict that or anticipate it? And it's really based on the idea that if the cycles on the higher time frame persist, the lower time frame will follow through. You've got to think about it as though an analogy would be, an owner walking their dog in the park. The dog is on a lead and the dog is running around sniffing everywhere and all over the place, but at the end of the day the pooch is going to go where the owner goes. All right, so that's how it tends to follow that. Now let's talk about, very importantly, let's talk about where traders get caught, because believe it or not, we can identify where the majority of traders get caught, including seasoned traders. First of all, you'll have an uptrend here. Now, think about it like this. You're only really looking at the lower time frame. So as a trader, you're only really paying attention to the lower time frame if you're not aware of where you are within the higher time frame cycles. And this happens a lot. A lot of traders here have identified a downtrend. They're seeing lower highs, lower lows. The price is pulling back up. They will look to sell here on the lower time frame, on the 15-minute, or let's just go back up. So the 15-minute, 30-minute, 1 hour, 4 hour, for example, would be day trading. Actually, the 4 hour sits, believe it or not, in the middle. This is day trading. This is higher time frame. The 4 hour is not actually day trading. Anyway, so what happens is we see this trend heading down. We look to sell here. We see price pulling back. We expect it to continue down. It starts to do that. It starts to move down and then changes direction and starts going up, which feels very personal to us. If we were selling, it feels as though the trend typically changed direction after we got into it, which isn't the case. What's really happened is that the higher time frame has just started its next extension, and the lower time frame naturally changes its trend to follow that. So the first area where newer traders get caught is that they are selling and their direction on the lower time frame is contradicted by the higher time frame. If they had looked at the higher time frame, they would never be selling in it. They would only be buying. You don't want to disagree with that. For example, if you're a day trader, you really do not want to go against the 4 hour. You just don't. If the 4 hour is trending up, you don't want to go against it. You will find statistically you have more winning trades when you trade in line with the same direction where the 4 hour is going. Right. The second place where traders get caught, and this includes seasoned traders as well, by the way. It's not to do with skill, it's just to do with timing. Here, often you'll have an uptrend on the lower time frame, you'll get a pullback. This is where your expectation is that the market has maybe got one more move in it before it starts to pull back. And often you get triggered in and then the market turns around. So you get triggered in here and the market corrects. Now, for seasoned traders, they won't make this mistake because they know they shouldn't go against the high time frame. They won't be trading against it anyway. But they may realize that they're getting in the very last trade here, and of course it triggers and comes back against them. So that is actually a legitimate area where seasoned traders realize they took the very last trade, there wasn't enough juice. Now, if they're very good, they might get the trade to break even, they might keep their losses small, but it is a very real loss. And very important, this is why traders will have stop losses here, because they will not want to get caught if the market pulls back further. And again, just showing you here, that would be the same thing. There'd be a downtrend here, market tries to sell, a new trader or younger or naive trader or someone who isn't educated or trained will decide to sell here, and the market, of course, will trigger them in and go up. And it does feel personal, but you have to understand that all of that is just part of the cycles. And again, this is a great area here. Why? Well, because at this point, right, both the lower time frames and higher time frames are moving up, and it gets and you can get some incredibly good trends here. And so of course you're looking to buy when it pulls back, but the higher time frame is now getting tired and it needs to pull back and do its own cycle. So we need to be careful of those. And so we always need this higher time frame correlation. We need to be aware, where is the higher time frame within its cycles? Which leads me, so this is where most of the losses happen between newer traders and seasoned traders. All right, statistical losses where you just got in at the wrong time. And this is more of a gauge because sometimes the market will give you that target and sometimes it'll run out of steam. Which leads me to, where do our best trades come from? Our best trades, ladies and gentlemen, come from when the lower time frame and the higher time frame have got lots of room to run. The higher time frame is pulled back, it's had a nice breather, it's just taken off. And of course, on the lower time frame, we subsequently get our very first pullback in the brand new uptrend. And again, the market pulls back. So we might take this trade here. This is trading, by the way, not investing per se. We will take this trade here. We might get another trade in here. And then we're out. Then we're going to wait. We know at some point it's going to pull back, run out of steam, the higher time frame. Then when the higher time frame takes a bit of a pullback, this might be the 4-hour coming back here, and the 4-hour starts heading out again. Then we get our 15 minutes. We get back in on the 15-minute. We capture this move. We get another move here. And this is what day traders do. But they always know. They always pick the higher time frame charts with the best trends, and then they try to capture a smaller wave on the lower time frame. Again, so this is where we get our best trades, is when the higher time frame is in the first half or at least first 3/4 of its move, and the lower time frame has got multiple waves on it that we can catch. Okay, that's ultimately what we are looking to do. So if we bring this back to a real chart here, we've got this beautiful uptrend. This is our higher time frame pulling back, heading out, higher time frame pulling back, consolidating, just taking off. So that's our daily just taken off. If I go to the German one where I said to you, it's just broken through, just starting to take off there. I go down to the 4-hour, all right? On the 4-hour, it has actually taken off. We need a bit of a pullback. We've got to the 1-hour. Let's have a look and see if there's a bit of a trend there. And here you can see the 1-hour is just pulled back and trying to head up a bit. Now, the market is wrapping up given the time of day, but it's likely to carry on tomorrow. Why do I say that? Well, because the daily has just managed to break out. The daily still has upside potential. Even if it's ultimately going to bump its head up here, tomorrow it should still work its way up here. And therefore, day traders tomorrow will look to find a nice opportunity here. They'll wait for it to pull back and take off. And when it starts taking off there, they will be looking for moves on the 15-minute, for example. The 15 minutes, if we have a look here, the 15-minute is now going into a bit of a downtrend. It's kind of done for the day. There's our uptrend. There's our temporary downtrend. There's our uptrend. We're going in our temporary downtrend. Tomorrow, we would expect it to return back into an uptrend. And that is what we are looking for. So seasoned traders or traders who are educated and trained, they know that this is how the market works. They're looking at the higher time frame to see where is the higher time frame going to go, and then they go down to the lower time frame and essentially attempt to catch a portion of the waves on the lower time frame. There we go, ladies and gentlemen. I'm going to leave you with this. If you found that this had a positive impact or this is something new to you, please give me a like and a subscribe. It's worth your while. And also, if you want to add anything in the comments as well, please feel free to do that in the comment section. And that is it. I'm going to leave you with this. Listen, have a fantastic week. There are some good opportunities out there, but as always, we trade carefully and cautiously. Thank you.